Hey everybody, this is Tom English, editor of the Southern Illinois, and I'm here with David England. He is a friend of mine, but more importantly, he is a financial genius.
Well,
that is the best way to put it, David. But tell everybody what you do.
Well, you kind of set the bar high for
Yeah,
me, Tom.
yeah.
Financial educator, stock market analyst.
Good. Well, we're here to talk about the stock market. We are here today at the New Coin State Fair, right in front of the grandstand. You can probably hear in the background, I believe that is Whitey Morgan and the 78s getting ready for tonight's show. There are still plenty of tickets available. You can check out some of what they've done too at thesouthern.com. We've run a preview story on everything that's happening here at the fair. But we're here today on Facebook Live to talk about the stock market and what the future brings. And we'll just get right into it, David.
Let's jump into it.
Yield inversion, what causes them and why are they important?
Okay, yield inversion is one of those things that's been getting a lot of press.
Okay.
Unfortunately, Tom, it's been scaring a lot of people about what it is. And then there's some people out there and some different organization that's trying to say that 100% is going to link to a recession.
Okay.
So let's talk about the facts on this. Okay, just a few points. Let's start out with number one. Government treasuries. That's what our government sells to raise capital.
Okay.
And money. Okay. And by the way, I can't think of a time where any of them have gone under default.
All right.
You can buy those treasuries from short term, from 1 month to 30 years.
Okay.
So let's just set the premise. Those are safe havens. And what's happening is overseas, when it comes to business anymore, we're like this international. At one point in time, foreigners were in Missouri and Kentucky. No more. We don't have foreigners anymore. We are interlocked. It's a interglobal. What happens in China, Japan, and Germany 5 seconds ago affects our market today. Unfortunately, across the board, overseas, many of the economies are going down. Okay? Specifically, China, Japan's weak, Europe, and what's happening is they are having so much weakness over there. The banks over there are having negative, and that's right, it's negative interest rates. So that means that you can put your money with the bank, and you say, why would you get a negative rate? Because you know the most you can lose. Compared to having it in their markets, there could be a lot of downsides. So keep this in mind. Overseas economy is weak. And by the way, United States economy is still strong.
Yes.
And stronger than the other ones. Okay? So many people internationally are coming into our markets and buying our treasuries.
Okay.
For years, they've been in the stock market, and that's one of the reasons why the market continued to run and continues to run going on 10 years, where the average bull run is a little under 5 years. We'll
Okay.
get to more of that later. So bottom line, what's happening? They're coming in and buying our bonds and our notes. A bond and a note is like a teeter-totter.
Okay.
When all of this large amounts of money are coming in internationally to buy the bonds and the notes, it's driving the price up. But what's that do? It drives the yields down. And that's why we're having record low yields, especially with like the 30. So what does this mean within the world of real? In a perfect world, the longer term notes, the 30s, the 20s, and the 10, have a higher yield than the short term. But what's happening now is all this money's coming in short term, driving the yield up, and that's what's inverting the yield curve.
Okay.
So then the question is, do they lead to recessions? Well, many times after we have an inversion, it leads down the road to a possible recession. But no, yield curves don't cause recessions.
Okay.
What happens is what causes that yield curve to be inverted is what possibly can cause recessions.
Okay. The key word there you said is possibly, correct?
Possibly.
Okay.
But I'll guarantee you, we will have a recession. That we don't know when it's going to be. Nobody has that idea.
No.
Okay.
We've been, I know that, I followed a little bit, and, I've been hearing since last February the word recession.
Yes.
The word recession. And it hasn't come.
No. Tom, I can remember in one of my classes at SIU, Dr. Waldron's class, when he was telling us about market cycles. And man, it just bummed me out here. Wait a minute, we can't have prosperity all the time? No. We have natural cycles. And by the way, whenever we do have recessions, looks like we're doing good. And folks, we're under the elements here, and we cannot see that screen. So just bear with us. I hope that we're still recording. And so anyway, we have upturns, we have downturns. This is perfectly natural. But what I don't like, and one of the reasons why we got together is to tell the truth. There's too many mediums out there that saying recession, recession, recession. We got one ahead of us, but it doesn't mean it's going to start tomorrow.
We don't know how bad it's going to be.
Exactly. And then something else. Many people are saying, hey, this is going to be the worst recession we've had in a long time. Well, how do they know that? They don't. So we'll just take it step by step. The facts are conditions are causing the yield to invert. That can cause recessions, but it's not guaranteed.
Okay, so right now, what are you watching trade-wise?
Trade-wise, from a trading standpoint, I'm not buying stocks. I do futures, and I also do options.
Okay.
Okay. What I'm watching are the indexes, the S&P, the NASDAQ, and the Dow, to see how strong they are, and that tells me, it gives me my clues that I look at since I'm a trader to see, is it time to go long the market and buy calls, or is it time to buy puts to short the market? That means we make money when it goes down.
Okay. So we've been talking a while now. This is our first time we've talked in about a year and a half. But
Yes.
before we would talk monthly and take me through your typical trading day. What goes on from the point in time when the market opens to the end of your day, and then how do you prepare for your next day?
Okay. When the typical trading day starts, my day is partially over, because any trader worth their salt will prepare the night before.
Okay.
And when we prepare the night before, we're taking a look at what's happening in Japan, China, and earlier in the morning, we're seeing what's happening in Europe. What we don't do is wake up and think, well, I got to make some money today. What am I going to trade? That's an amateur. That's a rookie mistake.
Okay.
So what we do, I will set the table the night before if I trade. If I do trade, it may be 3 days a week. If you are after it 5 days a week, you're going to get burned out. All right. So I have my trade setups, and then on a given day, I'll wait for that trade to come to me. In the stock market or business, you don't chase things. So if it hits my prices, I will trade. If it doesn't, hey, most of the time, if I'm going to be trading, the market starts, I do pre-market, but I let it set up, and many times I'm finished by 9 or 9:30,
Okay.
and that's it. It's not like I used to 7 days in front of the screen. Now, the last hour I may come in if I see an opportunity. But that gives me what's called, and these are the things that I teach, have a life as a trader. Okay?
Yeah, that can be good advice for any field, really.
I think so, yes.
So what kind of advice do you have for traders?
Okay, if somebody is trading, make sure that you're only doing that with a small part of your portfolio. The shorter the time frame you're trying to make your money, the higher the probability you're going to lose your rear end. So also remember, about 70 to 80% of those trades out there are computer versus computer. Back years ago, whenever I quit teaching at John A. Logan College, they were getting about maybe 10 to 15 trades off a second. Tom, now it's 500 a second.
Okay.
If you think you're going to outsmart that, good luck to you.
There's no way.
So be careful of the market moves, especially the tweets. You've got to, what I like to do is let the tweet happen and then let the market run or go down and play the counter tweet. The tweets that are doing a move in the market in a split second, because the trading is keyed off certain words, not just market conditions. So be careful of the tweets. One of the things I like to do is on a strong day like today, scan for weak stocks, so that if we have a strong market, which hopefully we talk about that, an up day like today is very deceptive, but look for strong stocks on a down day and weak stocks on a strong day, and then those are my trading candidates whenever that strength slows down.
What kind of advice do you have for investors?
Okay, I've got a simple motto: the closer you are to investment, to retirement, the more you should be concerned with the return on your money instead of return of your money. Tom, I had many students and people that were gauged to retire in 2007, 2008. But they couldn't because their holdings, they were buy and hold, they're in it for the long run. They drank the Wall Street Kool-Aid that money's always going to be there. And a lot of their holdings dropped even more than the market. Some of them were dropping 50 or 60%. So they had to work a long time. So with investors, we never know when this thing's going to turn. So that's why we must be prepared for it. And many times investors make their decisions emotionally after a big down day or up day. That's the worst time to do it. Right? So as far as investment goes, it's for the longer term, but as you get closer to retirement, move into those less risky investments. And key word of warning: bonds do not always go, or the bond funds do not always go up when the equity funds go down. That could be a very, very expensive mistake.
So you spent your life teaching.
Yes.
You have any upcoming classes or seminars that you're working on right now?
No, those days are behind me, and I was so blessed to be able to do my craft at John A. Logan College. And then I built my business and then did it national. Okay, had followers, members between Seattle and Florida. One thing I am doing is I'm working on an online segment if I decide to get back into teaching, where if people want to know about these classes, they can take them online, because I'm definitely not going to be in the classroom. Okay? And Tom, one key thing that just keeps haunting me about people that are investing right now, here's one thing. Let's just say that you are next to retirement.
Okay.
And you and your wife have built up this nest egg to retire. I know that's 20, 30 years down the road for you. But go back and take those holdings and see what they did in 2000 when the market plunged.
Mm-hmm.
See what those holdings did in 2007 when the market plunged. So here's just something to look at, because I don't do buy and sell signals.
No.
I teach strategies. If those holdings that you own now plummeted at 2000, that should tell you something. If those holdings, especially your bond funds, plummeted, even though say, well, I'm diversified. Well, diversification works until it doesn't. So if they should plunge in 2000 and 2007, whenever we have this next plunge, what do you reckon they're going to do possibly this time?
I'm going to say plunge.
Well, there's no guarantee, but make sure we do the homework, because many things repeat themselves cycle-wise.
Yep.
Okay?
Yep. And you can take that in life too.
Yes.
So, what is Wall Street not talking about that we on Main Street need to know?
Okay, let's just do two things. We're going to narrow this down. Be very careful on big up days like today, and I'll explain why. Whenever I left the market a while ago, and I kept my phone in the vehicle so it wouldn't be going off like crazy, on a big, large day like today, what can happen is the indexes are very misleading. Case in point, we've got the Dow, the S&P, and the NASDAQ. Those are the main ones. Let's focus on the Dow for this example. With the Dow, we got 30 stocks. They are not, that value of that index is not divided by 30. They've got it fixed, whereas the value of that is weighted to the highest priced stocks. So what does that mean? That means that what the big money, the institutions that move the markets, can come in and buy the top 10, move the value of the Dow up like it's doing today, and be selling stocks 20 through 30. And that can be very, very deceptive. Just because the indexes are up does not guarantee that your stuff is going to be up either. Okay? And then the second thing is what's one thing? Study closed-end funds, CEFs.
Okay.
Why? They're diversified with what's in them. Number two, they pay high dividends. The ones that I own pay 7 and 8% annually, and a large number of them pay monthly.
Okay.
You know, if somebody hasn't ever heard of them or want the list, I have a research business. They can PM me, and we can get together and I can give them more information.
All right. Great. So that's going to wrap up what we're going to talk about today. I'm also going to throw in a pitch here for the Southern. Right now we're having a sale. We've got our Digital Plus membership for $3 for 3 months. That is everything on thesouthern.com for 3 months, and then after 3 months, it's only $9.99 a month. That's a great deal right now. We always have a deal somewhere along the lines at thesouthern.com. Just go to thesouthern.com/members/join and see all the deals we have today. And until next time, David.
And we want to thank the folks at the Bitcoin State
yes.
Fair. Man, I can tell you, I've been coming here since 1965. It's a true honor to be right in front of the grandstand with you, Executive Director of the Southern Illinois, and with the people that are watching today. So thank you very much. God bless.
One last question I got for David. How do you like Whitey Morgan?
I tell you what, it's Whitey Morgan in the 78s. When I meet Whitey, I'm going to ask him why it's not the 76s.
Thanks, guys. Have a good day, and we'll see you guys soon.
Adios.
Are you all done?
We are finished. Time for a corn dog.
No, we're not.
Oh, you aren't?